Hi, this is Jonathan Miller, and you're watching the What It Means podcast. The topic today, or the title, is Think About Trading Places but with Lower Mortgage Rates. Today is August 5th, 2025. And for those of you that don't know me, I am the co-founder and CEO of Miller Samuel Real Estate Appraisers, based in New York City. I'm the author of the Douglas Elliman Market Report series. I've been doing that since 1994. And I teach market analysis at Columbia's grad program, Masters of Real Estate Development. And I'm the author of Housing Notes, which I've been writing regularly since about 2015. You can check that out. It's free at housingnotes.com. I encourage you to subscribe. So I want to touch on three things this session. One is about killing the messenger and how the economy is weaker than we thought, and why that's good for real estate. I'm going to talk a little bit about the New York City housing market, and that means the five boroughs of New York City. And I'm going to talk about the movie Trading Places with Eddie Murphy and Dan Aykroyd, which touches on derivatives or options trading and the idea of hedging against risk. And that sort of connects with the idea of rate cuts. So the first thing I'll talk about killing the messenger. So this what for the last couple of months, I've been sort of railing about tariffs and about sort of inflationary practices in government policy, like adding trillions to the debt, the national debt that the OBBB, I love that acronym, the one beautiful big beautiful bill adds a tremendous amount of debt, and why that's inflationary, why tariffs are inflationary, and the piles of uncertainty. We're at peak uncertainty. And so the biggest concern was, let's not create more inflationary pressure, because that's going to reduce the probability that we're going to have that we can have lower mortgage rates. And indeed, mortgage rates have been stuck just below 7 for the past 3 or 4 months, actually longer than that, but since the beginning of the year, at a minimum. And then this uh, last week, we had this sort of sea change, early August, that all of a sudden there was the revisions to the jobs numbers made May and June, in terms of jobs, look very bad. And in fact, July was underwhelming in terms of jobs. There was the numbers they threw about were 73,000, and they were expecting, double that. And we had something similar happen to this exactly a year ago, where we had something called the yen carry trade, where and this is way above my pay grade. It's beyond my sort of ability to describe to you, but basically what it did, um, it showed, or made the world overnight realize that the economy in the US was weaker than everybody thought. And that brought about expectations for lower mortgage rates in the fall, which of course didn't happen. Mortgage rates went up, but it was based on this sort of weird uh, way to trade currency and take advantage of low rates in some countries. And anyway, again, it's way over my pay grade. Here we are, fast forward to today, or to early August 2025, and we have the same sort of situation where overnight, people like me that were very worried about inflation are now um, uh, we're seeing finally actual data that's showing how damaging the tariffs have been. I mean, one of the things that has happened is the tariff policy was rolled out in April, and what happened was it took less than a month, and then we saw big drops in employment, and not only that, but it's the only reason why we have positive employment numbers is because of healthcare. If we removed healthcare from the economy, we would have lost about 50,000 people in May and June and a few thousand in July. But that will probably be adjusted lower like it usually is in the coming months if the president's replacement for the person he fired for generating, who was a very credible person in their field, um, fired them for putting out a negative report. So this sort of, behavior of firing people when you don't generate or don't issue reports that are positive is very dangerous for the economy in terms of understanding where we are at any given moment and what decisions we make. So this is not a good thing. And I think that with the weaker data that we're seeing on the real estate side, it raises the probability quite a bit that we're going to see not only interest rate cuts. I looked ahead at something which I sort of conflate with something else I'm going to talk about hedging in the movie Trading Places. But basically, the probability of rate cuts have just expanded significantly in the coming months. And this raises the probability, especially with much weaker employment data, that we could actually see mortgage rates go down further than what was thought. I'm not suggesting they're collapsing, but just any incremental drop in rates brings on more sales activity. And in fact, the preliminary numbers that came out today, the Freddie Mac numbers that I usually follow don't come out till Thursday, but the interest rates are already falling. Um, and I, and because this is a fundamental aspect of the economy, not like the yen carry trade thing in Japan in August of last year, that sort of lulled us into thinking rates would fall. Um, and they didn't really. This time, I hate to say it, feels a little different. But anyway, it's all kind of interesting. The other aspect to the tariff sort of tantrums that I've been calling is that there is a court case called VOS Selections. I have this all outlined in my housing notes, that is titled Killing the Messenger. There's a lawsuit that looks favorable to the plaintiffs, which is going to rule um, the um, the practice of the president by issuing tariffs is actually unconstitutional, and it is. It's a congressional power. It's not a presidential power. So it should be interesting over the next couple of months. The saving grace of this is that it removes or it reduces the chaos coming out of Washington that the tariff policy is inflicting. That's why we've had such big job loss or lack of growth since they were implemented. And I see it only getting worse if it continues. And we will see um, more rate cuts, but we'll also see more job loss. So it's one of those things I've said before, be careful what you wish for. Um, the other thing I wanted to talk a little bit about was before I get into the movie Trading Places, uh, is New York City sales. First of all, I have a pet peeve. One of them is when you talk to somebody in New York, I'm not a native New Yorker, I've been here since the 80s. or in the suburbs. Lived in the city, live in the suburbs now. Um, People refer to Manhattan as New York City or the city. And I find this all the time, especially with data, because you're trying to figure out, are they talking about Manhattan? They're talking about all of New York City. I have to like double check every time, which is annoying. So I always say Manhattan when it's Manhattan. But what's interesting is it was New York City is sort of, it's the city and the country. So anything that is not in the city is the country. And I think that sort of started with like the Hamptons, and you're in the country. And then you're in the city, and the city implies Manhattan, but it's also referred to as New York City. I just I find that really confusing. I mean, I understand it and all that, but I would think it'd be very confusing for people that are just visiting. Anyway, I've sort of beat that to death. The other thing, and I'm gonna sort of read off a little bit here. Every quarter, what I do is for Douglas Elliman, we publish research for Manhattan, Brooklyn, and Queens. And then for sort of extracurricular, using public record and other sources, I also collect the Bronx and Staten Island so that I can generate an overall sort of state of the city, rather than sort of being Manhattan or Brooklyn oriented for the maybe Queens. And just a couple of fun facts about the data. Um, One is that Manhattan is accounts for 32% of the sales. This is all second quarter data. 32% of the sales, but 52% of the dollars that transact. Over half of New York City, um, the real estate that transfers in New York City, over half of it, half of the dollars of the transactions is comes from Manhattan. Um, Queens is actually the second most transactions at 29%. Brooklyn is third at 25%. Staten Island and the Bronx are virtually tied at each at around 7%. Um, just one other point of interest, is that even though Brooklyn has 25% of the sales, it has 24% of the dollars, which is the second largest borough after Manhattan has more than double at 52% of the dollars. So there's a big jump in prices, as much as we talk about Brooklyn and people moving from Brooklyn to Manhattan to save money. Like, they're moving. I just had this conversation the other day where they're moving from, one neighborhood in Brooklyn, and they're moving to one neighborhood in Manhattan to save money, but it has similar amenities. And I thought that was interesting. Um, from a macro perspective, all of New York City, meaning all five boroughs, prices year over year, second quarter over second quarter, are up 10.4%. That's a big number. Um, and sales are slipped. They're down by about 1.7%. Um, Inventory across the five boroughs is stable, meaning it's relatively unchanged year over year. And the months of supply, which is my favorite metric in housing, I've told you many times before. It's the intersection of supply and demand. The formula is inventory in the numerator and sales for the month in the denominator. And it's 5.8 months. And I thought it'd be interesting to look at the different boroughs, to see, sort of how they stack up. And the slowest moving market, meaning the one with the slowest months of supply, is the Bronx at 9.6 months. So it would take 9.6 months to sell all inventory at the current sales rate. The second was Manhattan at 8.5. And by the way, the 8.5 is the long-term average. That's that's normal at 8.5, even though the national sort of number that's bandied about is 6%. 6 months is normal months of supply. And, I looked into this a long time ago when I was blogging, and this 6 months number that everybody uses to say that the market is stable, 6 months of supply, um, is made up. There's no data behind it whatsoever. It's just an even number that you can kind of deal with when you're dealing with 12 months. Um, and I think the lesson I've learned by tracking housing markets across the US is normal months of supply varies tremendously across markets. Some markets are just slower or faster than others. Case in point, Manhattan at 8.5, it fluctuates. When it was booming coming out of the pandemic, it was like in the sixes or even the high fives, which is really unusual. But for other markets, that's normal. When we were covering downtown Boston, the normal market there over the last decade was about 2 months of supply, two months of supply, which is blistering compared to, it's 4 times faster than what we're seeing in Manhattan. Um, and that's kind of interesting. And all this stuff, all the numbers for this, if you're curious, are on my website, millersamuel.com, and you can check it out. And it's a one page where I compare quarter over quarter, year over year, and then compared to the last 2 years ago and compared to 3 years ago. And you can see, prices, sales trends, dollar volume, inventory, et cetera, by borough. One thing's interesting about the report is that a market like Manhattan actually blend. I do two separate. I in the quarterly reports I do for Manhattan, it's co-ops and condos, but there's obviously townhouses, and so I blend in 1 to 3 family townhouses as well, because in the other boroughs, I'm doing co-ops, condos, and 1 to 3 families as well. So it's all apples and apples, so to speak. The um, the last thing I want to talk about is the sort of the movie Trading Places. If you remember that, it was Eddie Murphy's second movie. It was with Dan Aykroyd, and they were essentially trying to get back at uh, the bad guys in the movie for sort of, ruining their lives temporarily or throwing things up in the air. And and it was all about outcry trading, which is the screaming in the pit. Um, and it was all about frozen orange juice. And when we think about outcry trading, I had a good friend of mine, he's since passed away, who invited me and a couple of my friends from out of town in Chicago that were visiting, and we went onto the trading floor where they're screaming, and they're all wearing different colored jackets and big badges. Noted, I didn't know, what the differentials stood for. But they're screaming, and throwing their hands up and moving their fingers around, almost like sign language. And it was they were trading, I believe, coffee, sugar, and cocoa. And there was just a lot of action the day that I do. And I remember coming up in the elevator, and I remember one of the traders saying to his buddy, said, "Man, I have to have a good day today. My mortgage is due tomorrow." And I'm like, "Oh my goodness, I can't imagine living like that. I don't have the stomach for that." It's sort of like being a developer. Um, it is, the stress and, what you sort of have to fight through to get things done, is pretty difficult. So, I really respected their ability to do this, even though the trade floor is now automated. And so we're not really seeing that. The reason I bring all this up, first of all, the movie Trading Places, the victors, the stars of the movie, they'd all be in jail now. Like it's fraud. Like that's what they're doing is fraud. Like, but it was, and I just remember watching that movie. Like, I don't think anybody actually understood the technical aspect of what was going on. You just sort of, they guided you through. It was sort of reminding me of the, I can't think of the movie now, where the housing trade um, movie that just went on where they were sort of narrating it and you were like hanging on by your fingernails. I applaud them for doing that, but for the average viewer that was watching it, just sort of got the cues that they were winning and they were screwing the bad guys and all that. Anyway, I thought it was interesting. But something that I wrote about last week in real estate, and I don't think this is a good thing, but we're obsessed about mortgage rates. And we have this sort of misunderstanding that when the Fed cuts rates, that interest rates are going to fall. And that didn't happen last fall when the Fed last September cut 50 basis points and mortgage rates went up almost a full point, 100 basis points. Um, so anyway, for the last couple of months, I've been savagely going after tariffs because they're inflationary. They're a tax on the American consumer. And every time you read a comment like, we've made X billions of dollars this month, from all the tariffs and, it's all going to be great. We're not going to pay taxes anymore. Just remember who's paying the tariffs. The American consumer is paying the tariffs in the form of high prices. And I can't remember if I've discussed this on a prior podcast, but one of my sons is in the in a sort of fabric type business, a luxury fabric type business, and he's like the logistics guy. And they buy containers, I mean those shipping containers of material from China, and the going rate is about for the products that he is about 400,000 a container. That's what they pay. But now those same containers that were 400,000, the tariffs are another 250,000 on top of it. So they're still buying. The company is buying, for 650 what was 400, but they've already, they're making the decision they're not going to eat it. They're going to pass it along in the form of higher prices. And that is the way to think about tariffs. So what's so when we think about um, trading and hedging against housing, just remember that we can hedge non-fat dried milk, cheddar cheese, the weather, insurance, coffee, sugar, cocoa, lumber. I mean, it's endless, but we can't hedge the world's largest asset class, residential real estate. And that's actually what Case-Shiller was designed to do, but it failed because for many reasons, which I've discussed in the past. But it it wasn't transparent enough, and it was too slow. And I just finished teaching my summer class at Columbia, and the first thing I said in the first class was, I had a quick question for my students. There's about 150 of them, and it's a very sort of, the class is very active. Like I'm walking up and down the aisles and asking questions of everybody. Everybody was engaged. And I said, when you got up this morning, did you look up the average temperature of 6 months ago? And that was the basis of deciding what you were today. And everybody's laughing. I said, well, that's what the Case-Shiller index is. Like you're literally looking at what happened 6 months ago. And then the commentary is literally delayed from the meeting of the minds between the buyer and seller where they agree on a price. It's delayed about 6 months. That's worthless. What is that? Um, so anyway, the idea with why I'm bringing up the movie Trading Places is that the CME, the Chicago Mercantile Exchange, uh, basically as a free tool. You go on their website, you'll see it if you go to my post about trading the movie Trading Places, you'll see a link to it. And you can see what people that are betting, in the market, maybe they're betting on their computers now. They're not screaming and yelling with different colors of vests on in a trading pit. But they're betting on what the odds are for a future rate cuts. And given how weak the economic data is for jobs, it's terrible. You've all heard by now, like college graduates can't get jobs. Uh, college, their unemployment rate's like 10% right now. So you're seeing cracks in the economy. This is still kind of good for housing because it reduces or it increases the probability of lower rates. Um, uh, then the latest numbers I checked just before the podcast started, the odds of a rate cut of 25 to 50 basis points in September is about 90%. Versus last month, it was 96% no change, right? And they did that. It's 90% a rate cut of 25 to 50 basis points. In the next meeting in October, right now, the odds are 60% of a 25 to 50 basis point cut. And in December, it's 46% of another 25, 50 basis point cut. So the big question will be, I think it's, without being overly confident, I think it's realistic to assume that the Fed is going to cut the federal funds rate by at least in one of these meetings and probably in two and maybe in all three. And so the question is, should we care? Like, does it lower mortgage rates? And I think because this time, and first of all, the answer to this sort of next thing is who knows? But let me just, you're not watching this podcast or listening to this podcast for just a bunch of disclaimers. But I think the idea here is that there is fundamental weakness in the economy, that the damage caused by the tariffs is visceral. You can see it in employment, in the jobs numbers are really off, uh, like really off. And hiding those numbers from the public, as was done with the firing of the BLS commissioner, is silly. You can't hide bad performance like this. Um, and it looks like mortgage rates will come down. How much, I don't know, low sixes, mid sixes. But whatever it does, I think you'll see a real boost in sales activity. And that in some places, we're already seeing inventory growth slow down. So I wouldn't be surprised if, this fall we are experiencing much more activity than we were expecting, and maybe even more activity than we saw this past spring, which is very underwhelming. So in some ways, the bad news is brings a little optimism, if that's not confusing enough. Anyway, that's probably enough. I've probably beaten all this to death. But again, I implore you to, or just ask you nicely, to subscribe to Housing Notes, where I talk about this stuff and provide links all over the place, and it's free. Housingnotes.com. Give it a look. Importantly, I also want to thank you for spending your time with me, and I know it's valuable, and I hope you get something out of it. I hope so. Uh, but in the meantime, please remember that pie is better than cake.